Thanks for joining us on another For Investors, by Investors South Bay podcast. As always, we are proud to be your all-education real estate investment resource without any kind of sales pitch. If you would like to attend one of our meetings in person, we meet the second Wednesday of the month at The Point in El Segundo. You can RSVP at forinvestorsbyinvestors.com/South Bay. To find more investment resources such as blogs and podcasts from other FIBI groups, go to forinvestorsbyinvestors.com and search our library. Now, on to the podcast.
For Investors by Investors is started by a couple of full-time real estate investors that were tired of the sales pitch, the boot camps and the book and tape sets and all that fun stuff. And so they put this together where there will be no sales pitch at all in any of our FIBI chapters throughout Southern California, just education and networking. So after this, we try to network beforehand and we try to network afterwards, like at North Italia and stuff like that. We basically go afterwards to the restaurant. Like you basically can exit this door right here and then walk around, and we have like a whole happy hour set up where everybody's welcome to come and meet everybody and find the people that you can do business with, which is really the point of FIBI, was where can we go to get that networking that everybody wants, but also get educated on a ton of different topics. And today we have some great speakers in here that are going to talk about preparing for the downturn, because a lot of these two specifically, and you have a ton of experience in real estate as well, they have a ton of different knowledge about what it's like to go through the downturn and what they're doing right now on a massive scale for some really high-level investors that know what they're doing on this side to really prepare. And, after going through it once or, seeing the data on, what's happening or what happened last time, it's a great thing to do to prepare and get ready for this and make sure that you have those reserves and different things aside. So all of our different chapters throughout Southern California have a different topics on a consistent monthly basis, from flipping to multifamilies to self-directed IRAs to passive investing, and we have they're all on meetup.com. If you guys type in FIBI or For Investors by Investors, you'll find all of our chapters, and all of them will be the no sales pitch type environment. So that being said, Jeff, we got a Culver City chapter leader here. Jeff, raise your hand real quick and tell us a little bit about your chapter, man.
Thanks. Our chapter is FIBI West Side. We meet normally the last Wednesday of every month. So our next meeting will be in 2 weeks, the 29th. We meet at the Doubletree Hotel in Culver City, right by the 405 and the 90 freeway. We have an optional no-host dinner beforehand with the speakers. If you come to dinner, you get free parking. The restaurant in the hotel validates. Then we have a panel discussion, 2 people on one topic, different points of view, and then we go down to the bar in the hotel restaurant and do some more networking.
Thanks, Jeff. Appreciate it. Jeff is our newest chapter. What was it, with like 130 people in your first meeting or something like that, or RSVPs? It's pretty good.
200 RSVPs,
it's awesome.
And just under 100 showed up.
Awesome. Usually a pretty good ratio for California. Everybody does the, I'll be there. Sure.
So for 2 weeks from today is the tax changes for passive investors.
Okay. Awesome. Yeah, it's a lot of tax changes this year, so something to pay attention to for sure. So, and you can find your site. He's on the FIBI, he's on the For Investors by Investors site, as well as on Meetup.com too. So, Christina, you run the FIBI Pasadena as well. So, can you tell us a little about the 2 chapters you run?
I do. I run the FIBI Pasadena chapter. We have a meeting that's similar to all the other FIBI meetings: low or no sales. We have high networking beforehand. I do my little welcoming speech to kind of get everybody awake, and then we do some more networking, and then we have a speaker, and then we do some more networking. Did I mention networking? I'm a big advocate of networking, because when I first moved into real estate, I was doing a lot of single families, and then when I made my big jump into multifamily, I'm like, I don't know what the heck I'm doing. So it was my network. My network saved me. My network educated me, so I'm big into networking. So that's the third Thursday at Old Town by Pasadena, and then we also have another meeting, which is the first Wednesday, and that one focuses specifically on the multifamily market. I thought it'd be a nice small boutique meeting. We just started it about 5 months ago, I think, about 5 months ago. And actually, it already has about 40 to 50 people that come to it. So when we focus specifically on multifamily, less networking, more education. So networking beforehand, a video, possibly a deal to be analyzed, and then we do a Q&A panel. So
When again?
the first Wednesday is the multifamily in Pasadena. And so we just had Jay Massey present at our last meeting.
What's up, Jay?
Hi, Jay. Good to see you. And we had Matthew at our multifamily meeting. He was my backup. He was my backup replacement.
I gave her crap for it, and then tonight she replaced Jeremy for us because Jeremy broke his
Right,
ribs, and I'm like,
Jeremy.
great.
So we now we equally either insulted each other or complimented each other, depending upon how you want to see it. But we had Paul Moore cancel. But he'll be coming later in the year. We're hoping in May. We'll have Paul Moore coming. So, and we have Kirk Karlstrom. He co-runs the meeting with me on the third Thursday, and he's going to talk about how to fund a flip without your own money. I figure most flippers like to know how to do that, and he's been doing that for a while. Matthew could speak on that too, but we didn't ask you to speak on that one.
I'm tired of speaking. I'm going to let you guys do it tonight. Dave was already worried. Dave's not here tonight. He had a family emergency, but he's like, don't talk too much, Matt. You need to shut up every once in a while. So I told him I'll be making sure I talk trash about him the whole time, so it'll be all good.
Yeah,
but,
this is on Facebook, right? So it's going to be over the whole, internet, all the trash that we're going to talk about
right,
David while he's
so
not
the
here
internet
tonight.
knows Dave is horrible at golf like usual, and so do the same old tired jokes that I normally do, but it's all good. So it's what the CPA jokes you get. So. And just so you guys are aware, FIBI is a nonprofit, so we don't make any money at this stuff. We basically break even on our stuff, and so we have some sponsors that we'd like to thank for helping us with this. And we bring in sponsors that we think are really valuable for the industry, all the team members you need to be able to do this business. So one of the first ones is Jeff with UDirect. Tell us a little bit about what UDirect does, Jeff.
Yeah, thank you. So we're a self-directed IRA company, and what that means is we can show you how you can take your old 401ks and current IRAs and open up an account, move the funds in, and then buy assets like real estate. Things that are going to be discussed here tonight in IRAs and hold. You just have to work with a company that agrees to hold it. Because most companies limit you to stocks and bonds. Since the IRS doesn't limit you to stocks and bonds, if you want to do something outside the stock market, our company can help you accomplish that.
And I use UDirect a lot for my stuff and my clients, and it's one of the best strategies to use is investing your own retirement accounts into real estate and keeping it compounding without the tax implications associated with it. So it's a great strategy. Civic, we got Civic over here. Tell us a little bit about what Civic does.
We're a hard money lender, primarily working in the fixed income market. We're in 15 different states, and we also are doing value-add multifamily up to 100 units.
Great, thanks. In how many states you said?
15 states.
15 states.
So, basically Texas West and California and Hawaii.
Okay, great, thank you. And then we got the Note Assistance Program. You want to tell us a little bit about what they do?
So we teach investors how to buy non-performing notes all over the country and turn them into cash flow or capital growth.
Awesome, thank you. Yeah, they're basically do a ton of note investing and help investors, do that and buy these notes, and it's a great strategy to learn about. So I would highly recommend that. Anybody here from New Western? Don't see anybody here. New Western is basically a wholesaler on crack. So they do a ton of wholesaling throughout Southern California. Big company that does that. And then we have Walker Dunlop. Anybody here from Walker Dunlop? They're basically a commercial lender, and they're one of our sponsors as well. They usually come for the networking afterwards and the drinks, so they'll be here. And then we got Spear Woodward. Is anybody here from Spear? They basically are a law firm that specializes in real estate investing. So if you need help, they're based here in the South Bay and things like that. So, and then an honorary shout out to Jay over here. Jay is the man when it comes to short-term rentals, and whenever you got a professional investor like Jay coming, it shows that we're actually doing something right, or it's a good topic or something like that. So Jay, tell us a little bit about what you do, man, with that.
Sure, why not? So at Cashflow IRA, what we do is we create entrepreneurs. We leverage real estate strategies, specifically short-term rentals, helping people go through what we call a three-phase system. Learn how to get one, learn how to manage 10, 20, or 30, and then take those profits and put that into real estate to manage your taxable income.
One of the best courses I took from him was on that, and it was just amazing. So I highly recommend additional education and things like that when you guys are interested in those types of topics when it comes to fruition. So that being said, all of our chapters throughout Southern California are run by professional full-time investors that are doing real estate full-time, and they're all geared towards that no sales pitch type environment. So what I'd like to do is start off with the intros here and have you guys just kind of one by one explain your background, what you guys do in real estate, and what you're doing right now. So, Robert, I'll start with you since you're next to me.
Sure. Thank you. Thanks for having me. I appreciate it very much. I got started off very young in the real estate business and really started off wholesaling. Went into syndicating apartment buildings and flipping homes at the same time. And really with the apartment buildings that we were syndicating, we were really flipping those apartment buildings in the 90s when the vacancy rate was very high. And so we'd figured out a way to create stable buildings and then sell them to investors for a premium based on that we had long-term tenancy in those buildings. And then shortly after that, game died out, and I got into the hard money lending business. We opened up a company in 98 that we sold off a portion of it, and I got bought out in 2014. Since then I've been kind of flipping homes, doing some partnerships, and for the most part, lately we've been partnering with a lot of real estate agents and sellers as well to kind of help them flip their own homes. If that makes sense.
Great, thank you very much, Josh. I'm picking you third, Christina, because you're used to it now with me picking you second. So
I don't know if you can handle it.
You're not going to be able to deal with it. Josh, go ahead.
All right, thanks for having me. I really appreciate it. I'm Josh Satin. I am the Director of Acquisitions at Gelt. We're a multifamily owner-operator. We currently own 5,500 units we're in markets such as Denver, Salt Lake, Seattle, Portland. Prior to me working there, I'm a longtime real estate investor, actually on the LP side. I've been investing in real estate probably for the last 10 plus years as a limited partner before I started here. And so I kind of see investing in many different ways. And so I think I have a good perception of, what a lot of, people want to do, which is, some people want to be passive and some people want to be active. So I've done a lot of both. And so that's kind of my background now. I'm in charge of everything we buy, really. So
you do all the underwriting and everything else for it?
I do everything.
Just basically everything.
Yeah, so I'm in charge of sourcing, underwriting, touring, negotiating, financing all properties that we buy.
That's awesome. So you have a really good pulse on the market. What's going on right now, then, I would assume?
Yeah, on the markets that we're in, for sure. I travel a lot. We don't do much in California, so I'm on the road a lot, but I have a good sense of the markets that we're in.
That's awesome. That's a lot of units, man. That's great. Yeah. Christina, and yourself?
So I'm a brand new investor, and they actually found me at the last meeting, and I don't know why I'm on this panel. I've been investing for about 30 years. I started when I was 17. My mom had a home. She couldn't live in the family house anymore. She had really bad asthma. She had to move out immediately, and so I took it over. I'm 17 years old. I have no idea what I'm doing. I sold off some furniture, rented it out to my aunt and uncle, sold it to them on an installment sale, and then I bought a condo for my brother, and my mom's health recovered. I bought a house for her to live in, and it kind of grew while I was working. I had a job like everybody else, and some in marketing. I got fired from that job. I worked in childcare. I never got fired from childcare. I was better at childcare than I was at marketing. That's what it boils down to. And then eventually in about 2000, I ended up getting enough capital together that it was like, well, I'm going to move into a multi-unit. So I moved into multi-units, and that's when I would have considered myself more of a professional investor at that point because I had enough income coming in. I was retired. I've never told this, but I was retired for a couple of years and bored as all get out, not very happy with myself and not very happy being retired. So I ended up jumping back in again and doing flipping, value adds and I bought multi-units in Van Nuys, Knoxville, Tennessee, Arlington, Texas, Virginia, Hawaii, basically I kind of bought where I was traveling, was where I ended up kind of purchasing properties for a while. And then in the downturn, I sold everything, some of it at a loss, just pulling the assets back home. And I did all hard money lending, except for recently I'm back into flipping and hard money lending in the Pasadena area, mid-market, buying it between $1 million and $2 million and selling between $2 million and $3 million.
Shocker, a real estate investor, full-time investor that tried to retire. I've never heard of that before. She didn't have an itch going, I got this other deal to go, hey, you tried to retire too at some point. Yeah. You're like, forget it. I got to keep doing this. It's too much fun.
That's right.
So I have a list of questions here. Feel free to ask questions throughout. If you guys have questions, raise your hand and we'll definitely point you out and you guys can ask those questions. It's meant to be more of a Q&A, so feel free to do that. Yes.
I have a small objection. His notes are longer than mine.
Yeah,
I think I need to just step down now, and you can just talk to him. I think he's got it covered.
It's okay.
They're just doodles.
I'm gonna go off topic on purpose, just to mess
okay,
with things
just
anyway.
okay.
So the first question really just comes down to, this whole topic is preparing for the downturn and understanding, what we can do as investors to prepare for this and, not get caught like another 2008 type situation through 2012 and lose a bunch of money and have to sell stuff and bring it back. And, I took a big bath. I'm a full-time investor and I flipped over 700 houses. I quit my CPA firm job in 2006. So I got punched real hard when the market turned and my whole ego was based on my credit and my credit was ruined. And, that was the worst thing that could ever happen to me in my eyes at the time. But, since then we flipped, like I said, over 700. We do a lot of value add multis. We have about 10 million lent to different flippers in different markets. And thanks to Jay, we do a lot of short-term rentals now too. So it's been working. So, I'm very interested in this topic of not taking a left hook again to the jaw and losing a big chunk of capital. And you guys should be too, looking for this. Even if you're not investing, it's really important to understand where you should be investing and what things you can do to prepare. So from a personal financial situation, I'd love to be able to start. Christina, we'll start with you. What are you doing? I know you do a lot of business coaching and helping people with this exact thing. So I'd love to know from a personal financial situation, what are you doing outside of the investing piece to gear up for this? What are you putting in place to help yourself?
What am I doing outside of the investing piece?
Yeah,
what does that mean?
from a financial situation, are you putting reserves aside? What are you focused on? Are you getting ready to pounce on stuff that when it crashes? Like, how are you gearing up for this type of crash?
Okay, so I don't know how to answer it outside of my investing. So okay. I just don't. Reserves, yeah, I have reserves. I've been keeping reserves for the last couple of years because I've been waiting to see since about 2015. It's like, well, when is this going to happen? Because we saw plateauing in 2015. There was a concern that we'd go down, sort of have an aborted cycle, like go down quickly. So I have reserves, sure. Am I planning to jump in? Yeah, absolutely. I'm educating. What I've been doing outside of my financial world is educating myself on new places I can participate in, like the short-term rental. That's one of them. I would like to buy back into multi-units. Like, where do I want to go? But multi-units aren't ready and ripe yet. I'm leaving California, potentially, to do the short-term rentals, as well as potentially doing some in California. So I've been talking with my flipping partner for a year and a half. When this downturn starts, because it's going to start. What do we want to do? What's our plan? So we've been researching multi-units and have confirmed that we feel like that's not a strong place for us to go, even if we're trying to develop strong connections with wholesalers out of state. I'm like, no, we're not sure we want to double down on that right now. We talked to Paul Moore. We had a conversation with him about multi-units and what he's finding in the multi-unit market, and that he himself is no longer participating in that market. So talking to experts and trying to educate myself to be prepared for having a strategy when we're there, or now that we're there, depending upon your opinion.
So basically diversifying income streams and adding new ones if you can on the investment side as much as possible that may not be as susceptible to that downside risk.
Yes, nicely summarized. But first educating myself so that I can make the move.
Yeah, you can't just start a new business out of the blue and not be educated for sure. So
I tried to. I don't do it very well that way.
That never works out well.
It doesn't work out well.
How about you, Robert?
So I like niches. And so for the most part, what I try to do is look at what's happening in the cycle and then figure out what the next niche is going to be and then start to invest in something like that. And so if you look at the market today, you've got a lot of, I'm going to call them replacement buyers that are coming into the market, right? And so a lot of people think you're going to have this great boom because the millennials that are, ages 25 to 31 are coming on board and they're starting to buy. And so a lot of analysts, they look at this and they're going to say, hey, there's going to be this big boom that's going to happen over the next few years versus an actual recession. And I'm not a big, I think that a lot of the people that are very bearish on the market are selling a lot of seminars and they sell it on fear. And I think this is a great example of, we're talking about the downturn and it packs the room, right? Because everyone's, sometimes what they say is the best deal that you do is the one that you don't do. And so I think the fear makes a lot of people a lot of money. But, overall, the way I see the economy right now, I think it's trekking along. Sure, we've got some issues that are going on, but I think they're relatively minor. And when you couple that with the fact that you've got the millennials that are coming on, I don't think they're really going to spur this whole big boom. I think they're going to have the replacement buyers because the exiting demographics that are leaving are the baby boomers, which were the previous largest demographic. And so I think you're going to have kind of this even exchange, which is one of the reasons we haven't seen this big spike in sales. And, sales are, roughly in that 5 million, 4.9 to 5.2 million transactions a year for 5.5 to 5.6 for when you incorporate new housing. And I think that's one of the biggest things for the cycle. So what I'm looking at for a niche is how do you fill that niche? How do you fill the niche now where you've got sellers that are aging out? And, and part of aging out is that they start to sell their homes. How do we service some of that niche to appease the new buyers that are coming in? And so I think that's one of the reasons that we've taken a partnership approach a little bit more aggressively than others. I do like some of the multifamily plays. We're developing some affordable housing units. And so, there's a need in especially LA County specifically for, an extra 200,000 units in that affordable housing niche. Yet to, qualify or get Measure H type money, it takes, 4 years to kind of quantify that and go through the approval, get the funding. So we're putting together kind of private-public partnerships. We got a couple buildings that we're building that we got the county to waive all the property taxes for 55 years. So, 55 years, yeah. So the equal commitment for the affordable housing. When you go through the cycles and you just try to figure out these small niches, I like the niches. And so far as like preparing for when you do have a downturn, I think it's going to be a really relative soft landing here. I don't really see. And
the lower price point housing, the affordable housing stuff, the way you got that to pencil was that property tax issue that you were able to mitigate and some of that, because I think that's one of the biggest challenges. The construction costs and everything are so high, it doesn't pencil very well, right?
Right. Well, so there's two things, right? So if you're not using Measure H money, you don't have to use Davis Bacon funds, right? So you don't have to pay prevailing wages, and you can just work with the contractors that are a little bit more inexpensive. And then you couple that with not having property taxes, which typically account for about a third of your expenses or something like that of the expenses. That kind of makes the deal.
Right. Yeah. All of a sudden, it makes the cash flow and the property value skyrocket. Then
Tim's got a question.
Tim.
I have a question. What do you think about the opportunity zones? What they pose as an opportunity?
They're opportunistic. I think opportunity zones present God, this sounds terrible. A great opportunity, right? But it's. I think if you're buying and holding, those are the niches to do, because then that's just going to propel your net worth and your wealth with not having to pay all of that income tax. So I think that's if you're looking at here, the best deals that you're ever going to do as a real estate investor, even when you're flipping, are the ones you just hold long term. Because when someone else is paying off your debt, and they're, that's just, it's the best way. So if you look at most real estate investors, hey, they make great money. They're doing here, this, and this, and during the good times. But it's the deals that they held for long term that just make you the larger sums of money.
I wish I would have learned that earlier.
Same here. So I'll tell you a quick story. Is when we were lending hard money, I bought back when I was syndicating apartment buildings. We paid $225,000 for a 16-unit in Long Beach that were all 2 bedrooms, 3-story, 1970s elevator building, great. And at the time I was 23 years old, so I'm thinking, all right, we sat there, we filled it up, we got it occupied, and we got an offer for $680,000. We'd spent like $80,000 fixing. We're like, we got to sell this thing, right? This is great. Yeah, stupid. So here's what happens. Fast forward, I don't know, it's probably 15 years. And one of my clients calls me up and he's like, hey, I got this great deal. And he's like, yeah, I know. I'm getting this 16-unit building for $1.7 million that he thinks is a great deal. I'm like, I can't lend on that deal. And he tells me, he's like, why? It's a good deal. I'm like, look, just check title and it's just on principle. I just cannot lend on that deal. And so I didn't do the loan. I just sent him elsewhere. But I was just like, I'm like, fuck, it's just terrible, right? And so sorry, it was just, yeah, so
just that pain.
That pain. So that's
there.
an extra $1 million there, and the property was making money. We were just lazy 23-year-olds that didn't want to collect money. Right? We just wanted it to come all at once. So
that's awesome.
I want to give Josh a chance, but I have a comment to Opportunity Zone and the holding of properties.
Yeah.
I have a question about that. I don't think everyone in the room necessarily knows what Opportunity Zones are.
all right, no. So an opportunity zone. So last year, like early last year, they basically put out a memorandum to all of the cities, and the cities were allowed to designate certain areas within their cities as opportunity zones, where the IRS will, what is it? You hold it for 10 years if you invest money, and it's tax-free income after the 10 years. So.
It's like basically rolling money from a 1031 exchange into something like that.
If you sell a business or whatever, make money in the stock market or whatever, you can roll those gains into an opportunity zone fund. Right. If you hold it for 7 years, you get 15% tax break off your original taxes, and then if you hold it for 10, all the gains are tax free.
Yeah.
The thing is with it, what's actually going to end up happening is that the professional investors are going to have first find those things, get them entitled and ready to actually develop, and then sell them to a fund that is raising money for opportunity zones, and they're going to get a really low return because it's all tax benefits associated with it. So that's what's happening.
You have to put in at least what you bought the land for.
Right, so, and it's got to be 90%, right, of the money?
Correct. Yeah. So a lot of these deals don't pencil, but they do if you're taking off 50% for tax, or 20% for capital gains taxes. So I know a lot of guys that are solving to like an 8 IRR on these deals, but it's worth it for them.
Why don't they pencil?
Well, what do you mean?
It doesn't pencil because it requires
wise of what?
Right, because it's a requirement of the improvements.
Yeah, I mean, I don't think anyone would buy and develop a property for like an 8 to 10 IRR because the risk is not worth that reward. But it is when you're saving so much on taxes.
Yeah, they build that piece in, and it's basically, you're getting a lower return than you would normally get on any other outside property just because they know already that's an opportunity zone. So,
I mean, I think there's a niche right now in that if you look at LA just rezoned a lot of properties went from R1 or R2s into RD 1.5s or R3s, especially on the west side. So if you're looking at like opportunities, there's a lot of sellers that are still selling, what they perceive as a regular lot, and a lot of the developers have kind of jumped into those markets because they can buy. I still think they're paying too high personally. I mean, I agree with Josh. I think that some of these things don't pencil out, but I tend to take a much more conservative approach on anything that you're going to hold long term.
Josh, what are you seeing right now? As far as your financial situation and then the company as a whole, what are you seeing as far as how they're gearing up for this downturn, and how are they penciling that into some of their new projects and everything too?
So it's funny. I in 2016, I don't know if anyone knows what the NMHC conference is, but it's the big multifamily conference. It's either in San Diego or Florida. And 2016, the one in San Diego, I remember the first seminar I went to was how to gear up for a downturn, because everyone thought the downturn was coming in 2016. And so anyone that sat out from 2016 and now has missed 3 years of run-up, and possibly more. So we don't sit out. And I'm not a big believer in sitting out, but what I am a big believer in is long-term horizon. So I think the guys that get in trouble are the people that, when it's late in the cycle, are trying to get in and get out of a deal. So we always have a 10 to 15-year horizon. So we put on long-term debt, and we're willing to wait out, anything that goes bad, because in the long term, you're always going to win as long as you can, wait out a downturn. So that's really how we do it. We also decided to not pivot, but go into a different asset class. We started buying mobile home parks, and I personally started buying mobile home parks. It was good while it lasted, but I wasn't the only one that had that idea, and now it's like a ridiculous market. It's almost more competitive than the multifamily market. So I stopped that, but we bought 10 of them in the past 3 years, and I personally bought 3 of them. So that was an idea we had. We were buying them at like 8 to 10 caps, and they're now going for like 5 to 6 caps.
And what's your thoughts as far as why does that asset class fare better during a downturn?
So I actually listened to like a study, and I was talking to a guy that he is a full-time mobile home park guy. He owns a lot of mobile home parks. And in the last 15 years, maybe it was the last 20 years, mobile home parks have had 0 quarters of negative NOI growth, where apartments have had 20 quarters. You think about 2008, 9, and 2001, 2. Other asset classes, office and retail, have significantly higher. But mobile home parks have had 0. They've also had, in the good times, the least amount of growth. But if you compound the no negative, it's actually been the highest amount of growth. So our theory was, when things go bad, rents do not drop. And when things go good, they don't raise as much. But when things go bad, they don't go down. So that was our thesis. When you can buy them at 7, 8, 9 caps with downside protection, I thought it was a really good idea. And it still is, but when you're buying them at 5, it's a less good idea.
And I think what Robert was saying as far as the the lack of affordable housing and that kind of stuff is a big deal when it comes to mobile home parks, for example, because you're looking at where is everywhere in the country, people are going to be pushed as that wage gap widens and things like that into cheaper housing, and they're not making any more mobile home parks. I wish they would. That'd be great. But,
right, they're actually taking them away. And I mean, with apartments, and that's the crux of our business is apartments, but when things go bad, people can downsize and they could pair up. Instead of renting a solo apartment for $1,200, maybe you team up and have 3 people in a 2-bedroom or 4 people in a 2-bedroom. Which with mobile home parks, they have nowhere else to go. It's the lowest form of housing, right. And so it's definitely not bulletproof by any means, but it definitely has more downside protection than an apartment.
And on the multifamily side, what things are you adding to your projections and stuff like that when you're underwriting now for that potential downside risk, even on a long-term horizon? It's great that you're doing, what he said about the debt aspect is very, very important, because a lot of the guys that are doing the multifamily repositioning and get out, they have short-term debt, which is a big risk right now. There could be major changes. Now, we'll see what happens in the economy. It looked like they were pushing to the debt rate higher, and then now they're cooling off on it a little bit and bringing it back because they realize they can't really do anything to help the economy with reducing the rates right now. They have no more power. But what are you seeing as far as the underwriting on that and then underwriting on the debt side?
To your point before, though, on debt, I think it's kind of a misnomer that the people that got in trouble in downtimes couldn't pay their debt. That's not right. The people that got in trouble, their debt came due and it wasn't worth as much as their debt anymore, and so they lost the buildings. So that's why we have a long-term horizon. I think in good times, it costs us a little bit on the exit, but in bad times, it protects us a lot. As far as underwriting goes, it's just, we never were big on predicting rent growth. Some deals that we had, I look back at some of these underwritings I had with deals that we did 5 years ago, 4 years ago, and I was projecting 2.5% rent growth in Denver in 2015, and it was 12%. So we never were projecting that high, but now we're definitely projecting a lot lower organic rent growth, and I think it's really difficult to go into a deal without a plan to actually add value. Whereas in 2014, 15, 16, you can go into a deal with no plan and just ride the wave, but now you have to actually have a plan.
I agree. If there's some major major change in the market or something like that, you need that downside risk protection by adding that value to the property, increasing the value and getting that built-in equity into those properties. And, unless you're doing a tax benefit deal or something like that, it may not make sense to buy a building that's fully done already and operational. Unless you're buying it from me, then that's fine. You can buy one from me. That's not a problem. So at top dollar, don't worry. So yeah, exactly. So yeah, there you got the new one, right? So that's awesome. Yeah, all the chapter leaders like Jeff and Christina and everybody are all these professional investors that do this full time. So great resources on different asset classes. Like Joe from Orange County does a lot of the mobile home parks and things like that. He's actually retiring off of those now for probably a year, I would assume, until he gets back into it again.
He gets bored and then he'll come back.
Right, exactly. So. Robert, you do a lot of flips and things like that as well. What are you seeing? How are you underwriting your flips differently now with a potential downside horizon? I know a lot of times you're in and out in 3 months, 6 months, which helps mitigate that risk. But is there anything you're doing on the underwriting side?
For the most part, we're just at this point for us. No new construction. We're not looking to develop any single families. The multifamilies are a different story. But really anything that's especially on the high end, we're just I'm totally out of the west side. I'm totally out of, I've got one more, I think, in Culver City that we'll be out of in the next week or two. And short of that, the areas that are saturated, one of the things that we started doing early on was looking at the permits that were coming online, and because that was going to be our competition a year later. And so when you saw the permit, everyone jumped into like the Alphabet Streets, which is in Pacific Palisades and some of the other higher, west side areas, only in that they saw a few investors all of a sudden make, $700,000-$800,000 on a deal, and they're like, oh, everyone wants to jump into this deal. So they jumped in, but that's a very small buyer pool, right? So you had all the inventory levels that just kind of increased, and then some of those people were getting killed because of the debt service, and whereas back then they were holding them for a month or 2 months because it was a very frenzied market. You had lo and behold this glut of inventory that hit that was far beyond what the buyer pool was. And, then the absorption rate takes a little bit longer than, profits diminish. So we were fortunate to not get involved with that and got out and just kind of, part of it is discipline. When you're doing these deals, you're looking at all these transactions and they look really good. And then, but you see the data that's in front of you, you have to listen to what it's telling you. And that's like I mentioned earlier, is that, I like data. I like looking at data. I like listening to guys that listen to data, and then, versus other people who are they kind of ignore something because there's that greed factor, right? And then the data always wins.
Question. So on your point with data, I was actually sharing this with Josh. No offense to that. When I look at the data, one could say that would be that artificially low interest rates for an extended period of time, which would therefore mean every action deserves an equal and opposite reaction. As I go out there in the marketplace looking to either obtain mixed use or multifamily of various size, yes, because of my use case, I can make up for some stupidity. But at the same time, I don't want to be called. When I've been shopping for financing for stuff like this, I'm seeing doing two, even like a doing two. That doesn't go.
Do in 2 years? Right.
Doing 2, doing 5, and I'm still even nervous about doing 10 because how do you know the other side isn't going to be just as long?
Yeah.
Thoughts? Anything?
For financing or for just the longevity of the market?
Well, it's a combination of both because if it comes to at the wrong time, we don't have a problem.
So I think that interest rates are going to remain relatively low. I don't really see a reason for them to raise interest rates in 2019, probably not in 2020, to anything that's significant. I think that if you get to a point, and part of that is that, oil production is really, really well. The U.S. is producing more oil. Oil's down at $43, $44 a barrel. It really needs to get over $53, $56 a barrel to see any type of real inflation. And so until you see that, you're not really going to see interest rates rise. And so there's nothing on the horizon right now that shows that that's going to be a change. And so, I think to have some problems, you need to have inventory levels, consistently above 6 months. And then also you have to have interest rates probably above 5.875 or something like that to then start to say, hey, we're going to have some issues. But, that's not in the foreseeable future today. if you're planning out 1 or 2 years. Now, on the multifamily stuff, I mean, I would look at some of the other financing like, what is it, the Community Alliance or the Century financing, for locally anyhow. I mean, that's longer term. You can get more than the 2 years.
What are you seeing on that?
10.
Yeah, that's part of your challenge.
Can you sublease that to another entity and master lease it and then do the short-term rentals out of that possibly?
That's a good idea.
I mean, because I can imagine,
That's my biggest
Yeah, but your returns are good enough to why not just like syndicate it? Why don't you just put together a fund and syndicate out the building to?
Jay wants to keep it. He wants to keep it. No more outside money.
I mean, because now what you said is when they go and watch the TV, instead of dealing with just my emotions, they got to deal with all their emotions too.
Because people generally suck, and so you want to.
Right now, it's just not doing that.
Yeah.
I've been finding, I've been pricing out a lot of the multifamily financing, and California, you're looking at like a 50% leverage ratio because it's like an inverted interest rate on your cap rate. Your cap rate's 5.5, and your rate's at higher almost. But what I've been finding is, if you're less than $1 million loan amount, forget it. There's no reason to ever go there, and you just use private money for it. But if you're at $2 million plus, there's hundreds of lenders. But I've seen them give 75%, loan to value, 10-year fixed at 5.5%. But it's got a cash flow, right? So and that's obviously Midwest markets when you can get leverage up to that and still have a debt service coverage ratio above 1.35. So, but and then the big stuff, HUD and those types, you got to jump through a lot of hoops and everything. But I've heard about financing. I don't know if you know better, like 4.5%, 5% rates and 30-year fixed.
I haven't seen 4.5, but
I saw a guy that had 4.5 and a 30-year fixed from HUD, and I was amazed. I was like.
At like low fours right now.
Low fours? And what kind of loan size though on that?
Yeah, I was going to say,
terms?
what's your loan size?
Oh, like the amount?
Yeah.
Like 40 million.
Like 40 million? Yeah, well.
40 million.
Yeah, you get kind of good money at that kind of rates there. You're dealing with 40 million. That's crazy.
We're between 5 and 10 is what we're looking at. So it's not one, but between 5 and 10.
it's probably worth for you at like the size that you're at already to hire someone to just work on that side for you. Like just to hire a finance person in-house to just go out and start soliciting that, because I think, you'll connect with, you're what? Yeah.
I got a guy for you if you need a referral for that. He has a lot of these broker relationships. He goes to a lot of the different conferences and things like that for those. I was like, where's the conference? I want to go.
Yeah, you're
I
already,
want that relationship.
For sure you're at that point already where should get off your plate.
Who are some of the lenders that you guys work with in the higher markets?
In the higher markets, meaning like
Josh mentioned 40 million.
Yeah, we're using like the government agencies, so Fannie and Freddie. There's some CMBS stuff that we've looked at, HUD as well. HUD's too much of a pain though to go through, but that's who we use.
Yeah, if you want to find a lot of them, he mentioned the multifamily conference. If you just look at their expo, they're all there.
What's the conference name again?
NMHC.
NMHC.
National
National
Multifamily
Multifamily Housing Council.
Yeah.
It's in San Diego this year, so next year it'll be in Florida. So I wouldn't know, but the year after, San Diego's usually go.
I have a question for you, Robert. So you have stopped. Okay, so you've stopped doing new construction. You I a developer that I've worked with who, his niche is 3 to 5 million West Side. He stopped purchasing. Obviously that market is slowing. It seems like sales are taking longer. And I'm in a project right now, a flip in Culver City also. And I have some partners who are probably going to want to do a 1031 and move into something different. In that scenario, it sounds like you would look more toward multifamily value add. Is that what you're saying? Or would you sit out for a bit?
To 1031?
What?
You're going to 1031 out of a flip?
Yeah, it depends on, provided we can hit our number. Yeah. Which it looks like we will.
You're going to hold it longer than a year?
Yeah.
Is the flip taking longer than a year?
No.
You don't have to hold it for a year.
No.
Your intent has to be to hold it though, right?
Yeah.
Maybe it was my intent.
find a way to document that.
I don't know what happened.
I was going to say, or it could be two tax returns. That's also good.
2 years, you buy in 1 year, hold in another.
Buy it in December, sell it in January the following. That's 2 tax returns.
And you should also have.
We did do that, actually.
You should also have different entities too. If you're gonna, I mean, just if you're flipping out of one, that shows a lot of intent that you have one LLC or something that you're continuing. And this was your whole LLC, and I got this offer I couldn't turn down. That's a little different than hey, yeah, we're a dealer here, but not with this one.
Document the pencil it out on the cash flow. If it makes sense.
Yeah. But I mean, if you're going to 1031 into multifamily, I mean, in that type of case, I mean, I'm a big fan of kind of value add, so I like really crappy buildings that we can make, much better and increase rents. So I like non-rent control. Long Beach, I like, some of the outliner kind of LA County areas I like a lot. I'm not real big on LA City. LA City, the stuff we're doing there is it's either new construction on the multifamily side. I have a lot of friends that are still doing the duplexes and fourplexes and, doing pretty well with them. But you have. Yeah. So the duplex, fourplex plays are pretty good, especially on the west side. Yeah. You get K-Town going west, and that's pretty good. You have to have, it depends on what you can build for, right? So if you're efficient and you're building at like $100 or $125 a foot, then you're pretty good. But if you're building it.
Are you doing that?
Yeah, I was going to say, what market are you building in?
Well, I mean, so
he's really experienced. So.
No. But here's what happens, right? Is that if you're building in let's say the hood, that's what they're building for. So when you have a shortage of rentals in the west side, they take the hood builders and put them into the better areas, and they don't care because it's new. So, it's most of the cost is going to be in the design of your structure, right? So if you sit here and you have a more intricate roof line and you do all this, then your construction cost is going to go up. But if you sit there and you kind of essentially just create a bread and butter model where you're faking the nice look, the rents don't change. So if you're looking to keep something, then do that model, because there's more protection from the downside than if you're spending, $250 or $275 a foot to build something. So, you can fake the modern stuff with all the glass. I couldn't do one of those now for under $350 a foot, but we can fake it with some kind of windows and all this and be at like $175 a foot. And, is it, well, I mean, but really, it's not 10-foot ceilings. There might be 9-foot ceilings, right? And so you don't have this wall that opens up in the corner, has no beams or not. I mean, you're just talking about cutting all of the expensive costs out. And for some homeowners, they don't care. I mean, we're even seeing some of the buyers now that aren't we stopped, before when we were flipping, we would open up all the walls, right? And so you sit there and it's that open floor plan that everyone wants. And so now at this sector of the market, the name of the game is to get in and out as quickly as you can. And so really it's like your worst enemy when you're flipping homes is time. Right, especially if you're taking debt on it. And so if you're quick, you're going to make more money unless the market is really booming. And then when the market's booming and you're seeing, 20+% appreciations a year, then slow down because you just make more money naturally, right? But for today, the whole name of the game is to get in and out. And most of the people that are buying, there's a lot of people who, they don't really want the open floor plan anymore. If you lived in an open floor plan and you have kids, it's freaking messy because you see everything.
Loud, yeah,
it's loud and it's super.
Lots of toys to pick up, always in the way.
Right. And so, a lot of people like the regular floor plan. So now we might open up the kitchen a little bit. So it's not just the doorway, but we're not getting rid of all of the walls and doing all that anymore. Now it's just a matter of okay, let's get out of here quickly. How can we finish this construction in 30 days? That's our goal. And while we don't hit it, we do end up at 45 or 60. And then the deals that we've, really gotten killed on are the ones that we've kind of neglected and they've taken a long time. And those are the ones that through our own fault, we just took a lot longer because we placed a priority somewhere else.
That's what happens when you start doing a lot of activity is you start letting some go and they increase inefficiencies.
Right.
There's also been a lot of rain.
There has been a lot of rain.
But I have a tendency to do what you're doing, which is, if you've got 1031 money, what do you want to do with it? You want to move it from an appreciating market to a market that's more stable. And so it's like, well, if I have to move it, I have to do it in 180 days, then I don't want to do it in a market like Southern California, which is going to appreciate and depreciate right underneath me. So I'm like you. I'm like, no, just take it out of state, take it into Apple Valley if you intend on staying in state, right? But take it somewhere where the appreciation isn't going to go out from underneath you because you're stuck in that 180 time period.
Yeah, I like the other thing too. Is if you're going to buy in 1031 into something, pick an area that has a significant upside. And part of that is just doing homework. And again, it's listening to, like, okay, if you look at Hollywood, I mean, you would have loved to have bought stuff near like Hollywood and Vine 15 or 20 years ago. And it was easy to see how much money the city council was going to put into that area between like all of the public transportation, the upzoning of the area, and you just saw that was going to happen. And so if you sit there and you go to whatever city you're investing in and really meet with the like city planners and find out what their long-term plans are, because they don't plan, 1 or 2 years in advance. They're planning 20 years in advance. And so if you've got a long-term hold, figure out where that area is that they're going to incentivize other investors to go into. And then those are essentially what becomes the trendy areas.
I think the part of this, discussion on the downturn is obviously really important, and when you're talking about the specific areas you're investing in. Josh, when you are doing your research on these different markets, what are some of the metrics and some of the things you're looking at as far as the market goes to determine where you want to invest next and what area you should focus on?
Yeah, I mean, everyone talks about population growth, job growth, all these metrics, which is great. But the two things I look for the most are where are young people going? And my favorite stat, I guess you want to call it, is what's the income to rent ratio. So in LA, I just did this whole study because we put together this package for a deal we're doing, which is in Denver. But in LA, it's like 42%. San Fran's like 48%. Seattle's like upper 30s, and Denver was 26%. So this is my thesis on why, just as a full market in general, why I like Denver compared to some of these other Western growth markets. I think there's a lot more room to go, and in a downturn, there's a lot less room to fall. People are making a lot of money, and they're not spending that much on rent yet. That's kind of a number I like to look at. And then, population growth, everyone likes to point to that, but who's coming? What kind of people are coming? Are they renters or are they buyers?
You guys, you brought this up as well as far as the millennial growth coming in and things like that. Aren't they all broke? I mean, basically, can they afford it? Do they have jobs and things like that? That's what I think about it initially, but maybe I'm not researching it, of course.
Yeah, it's what kind of people are coming, where are they working, and what jobs are driving them, and that's really crucial, for us. Is it a job that's stable and that can withstand, not anything, but plus or minus
withstand automation as best possible?
Correct. And are those people going to be consistent renters that work there? And are those jobs going to be there for a long time?
I think it's important too to understand as well. Go ahead, Christina. It's looking at this, you're looking at the specific city issues and things like that. Some of the changes that are happening. Inglewood just enacted rent control, for example, and some of those things are something to pay attention to. Do you guys look at that kind of stuff when you're investing or when you're focusing on this? Obviously,
I'm like rent control. Yeah, of course.
Yeah, I mean, we don't invest much in LA, but in our 4 core markets, Portland just enacted rent control. And it was a 9% max, which doesn't seem that extreme, and it's actually not. Right. But is it the beginning of something greater is kind of the concern. So landlord laws are crucial for us. California's terrible. And really the West Coast is becoming pretty tough to deal with. So I think that's definitely something big that we look at.
I would say that rents have peaked like here in the West Side for sure, or in the West Coast.
I won't buy in with this rent control. I just don't buy in with this rent control because I don't want my capacity to value add to a building or to change my tenant occupancy over. I don't want that to be limited. So I just don't buy in.
Yeah, we took our the buildings that we have, and we just essentially we raised everyone's rent in anticipation of that law that was passing, and then gave them credit vouchers for the duration of their lease, so that if it was enacted, that we had a higher basis, and then we also bifurcated the garage outside of their lease, so we charged them separately for the garage, so that we had another increase, that we can then rent that out separately, and it doesn't have to come with the unit.
Short-term rentals are not subject to tenant landlord laws either, so that helps a ton, So, and I think, you got to watch out for places like Illinois that just doubled property taxes because their pensions were broken. What cities and states are going to follow suit in that arena as well? That could be a gigantic issue down the line. So we got a question here, and then we'll go to the back.
Yeah, so related to, like you said, you just did a study on where do you go for sourcing that data?
Census.
That and then also millennial.
Yeah, a lot of it's from the census website, and then for the actual rent to income ratio, I googled rent to income ratio, and there was like hundreds of articles that came up, and I just kind of aggregated the facts. And most of them were pretty similar.
So I want to underline something here. So we've heard Robert and Josh both talk to, long-term plan, long-term holds, right? And I guess one of the primary things that I wanted to kind of get in here on is long-term holds make a lot of sense if the numbers make sense at the time you purchase it, right? So if you're buying an apartment building at the top of the market, yeah, you can buy an apartment building at the top of the market, but you want to make sure it holds itself up and gives you a return. You can buy it any time in the market if that property pencils. So then it's like, sure, that's got a 10-year, 20-year horizon line. But if you buy and it doesn't pencil well, then when that market churns, you're going to end up selling that property. And you're going to end up selling it at a loss because it won't sustain itself. And you haven't underwritten the rents that are going to go down, or you haven't underwritten that your loan, you're going to be upside down in your loan if it's a single family. So, again, I just want to sort of like, because I'm an educator, right? So it just, I got to say it. Like, you got to make sure it's underwritten correctly.
To add to that, I see a lot, and I can relate this to single family as well. But in our industry, somebody like does a whole renovation value add plan and then sells to the next guy a re-renovation during the same cycle is, I think, where people could get in trouble. Penciling rents that aren't achievable in a market because they want to make a deal work. And I would equate that to what you were saying about the West Side. I live on the West Side. I own like a small house in an area that they've all been demoed and built up, and now it seems like that's people are getting caught. And I think they're trying to overdo it and get these really high prices. So I equate that to what people in our industry are doing, trying to get these really high rents that in these submarkets aren't possible. But that's the only way you can make a deal pencil is if you get those rents.
And I see that a lot in syndication deals, or people who are looking to buy at the top of the market. Like, they're super excited and they're, oh yeah, rents have gone up historically 7%, 8% over the last 3 to 4 years. And I'm like, I don't care. If you're planning on rents continuing to go up and that's how you're making it cash flow, you're going to have a problem. I want to see 2%. I want to see 3%. I get concerned if I see something where somebody's presenting me a deal, even a purchase or pro forma rents that are 3% or more. That's not, to me, that's not reality, and there's no underwriting to the downside in that. There's no protection in that.
I think it's really important to underwrite all of your properties and especially your commercial buildings and multifamily to where your rent could drop and understand what it dropped last time in that specific area to see, is it if it goes down by 10% or 15%, are you going to be underwater? Are you going to be break even and okay? Exactly what Christina was saying.
Yeah, when I work on multi-units, my underwriting, I actually do a 20% vacancy factor. And the reason why I'm so extreme is because between loss of tenants, downturn in rents, and concessions that you're going to be potentially facing, I want to make sure that I can afford my loan at a 20%. I want to make sure it's break even at 20%. And you want to know the floor and the ceiling of your loan as well.
What we do, or what I do, I guess, is what happened in 2008. And if I double that, as far as how bad it went, will I still be able to pay my debt? And if I can, we're okay.
That's good.
That's kind of like been our philosophy.
Robert, what are you seeing right now as far as last time we had a lot of mortgages go bad and a big blow up right there, of course, and a big lack of liquidity in the market. What are some of the big risk factors that you're seeing right now in the market as far as the governments, as far as economics internationally, that kind of stuff that could trigger something that could make a fall happen?
So, I mentioned oil prices having to go up and, short of there being some sort of war that is going to just skyrocket that, which doesn't seem to be the case anytime soon. I don't see those factors. I mean, I really see interest rates kind of staying pretty level for the foreseeable future, and kind of going more towards a model similar to Japan, where it's just kind of trekking along and there's no real growth, and it's moderate, and you'll see minor growth and little niches, and there'll be downturns and, really regional. But if you look at like it on a more macro level, I think that you're going to have, the economy stay pretty good. I think that with regards to, like a recession, I'm not a big kind of, hey, we're the sky is falling. I think that we're going to have even if we have a recession, it's going to be really short-lived in that we have this demographic that's out here that's 25 to 31 that's going to hit that replacement buyer type, and so you're going to have really inventory and demand kind of follow suit, and so it may shift one way or the other slightly. But I don't see this kind of major crash happening right now. I don't really see these red flags. I mean, that's not really my, that's the kind of not what I'm seeing. I don't know about you guys. I know you're like in the high end.
Yeah,
right?
I have a slightly different point of view.
So the high end, I think that, you look at the high end here on the west side, I mentioned I got out because it got saturated, and so it's getting hammered right now, right? I mean, it's getting really beat up.
We do have buyers coming back in now. We actually are seeing people.
So here's what happened,
right?
But you had a spike in the market, or a spike in the inventory, that inventory levels went up to 6.7 months in October, November.
Yes.
Yeah, and then now they're down
9 months above 3 million.
Right, and now that's right. And so now the market itself is down to 3.9.
I don't have the most current data. I know it's not in my notes here.
Yeah, single families. Hang on.
I've got the national.
All right, so right now we're at 3.9 months of unsold inventory. And that's up from 3.7, but it spiked, and it's already
nationally, though.
Nationally.
That's national.
That's national.
But it's not regional. It's not by price point.
And listen, when you're flipping, really, national doesn't matter, right, as much. However, if you look at your market and you look at the spike that we had here, it's working through its way through. It was a quick spike because everybody got nervous with interest rates. I mean, really, the Fed had no business raising interest rates in December. It was just, and it was. I think it was more political than anything else. But that's just, there was just the data didn't point to, hey, we got to raise interest rates again, and yet they did it. And so I think the market reacted to that, and people were anticipating some of that. And when you have a market that was forecasting, I think it was like a 10% chance or something like that they were going to raise interest rates, and then they raised it, the market reacted adversely to that. And so, I think that we're working our way through it. And the other thing is that when you look at a real estate cycle, if you're flipping, the cycle goes this. It's like, okay, everybody looks at year over year, like appreciation or depreciation. Really, all of your appreciation really happens in the warm months, right? The spring and early summer months. And then you start giving back some of those things in the winter months. So I don't buy, personally, I've done this for years. I don't really buy any properties unless it's just a home run deal in September or October. And really, in like maybe mid-November, I start buying again. And I love December. December, January are the best months to buy because we're selling in spring, right? And so if you're sitting there,
and the banks are liquidating, so December.
Well, yeah, but a lot of people are liquidating. But here's what happens, right? If you're buying a property in November and your 6 month or 3 months comps are stuff that sold in July that were really bought in June, that's the frenzied peak, really hottest part of the market. You're not going to hit that comparable sale when you go to resell it in January. And if you look at this past December and January, we're in California. We've had a lot of rain. And we're like, all right, hey, it's beautiful. Everything's green. But nobody does anything when it's raining here, right? I mean,
it's right? Like unless
you have to buy.
Yeah. Rain is California's snowed in.
That's right. So, so everyone's sitting here and, it just kind of stalled that market. So this inventory that was created, through that, I'm going to call it a blip, and it's happened before, and it just works its way through. So if you're caught on that and you can wait it out a little bit, you wait it out. If not, you just drop your price, get out, and move on to the next deal.
I have a slightly different opinion.
You would.
Yes, I would. I know, it's horrible. I have a slightly different opinion because I don't think the Fed is done raising rates. I know that they raised rates 9 times since 2015.
We have a bet for this, right?
We do. We should make a bet.
Let's make a bet.
Seriously, make a bet.
I think.
You guys should raise the rate of the bet.
Yeah.
We should raise the rate of the bet.
$1
every year.
$1.
We raise the rate of the bet.
Yeah.
I'm not a betting gal, but I might bet you on this just because we've talked about it twice now. This is our second chance. So I personally do think they're going to raise the rate. I think that they raised the rate 9 times. They raised it 4 times last year. I think they said in their last speech in December that they intend to raise rates in 2019, but in a more mild fashion than they have in 2018. I think we're seeing GDP is stronger than 2%. Yay, finally. We're seeing unemployment be at, I think below 4% is considered. Right, we're below 4, but below 4% is considered the market. 4% is a fully employed market because everybody needs to move sometimes. So you're always having a 4% gap in there where people are naturally changing jobs and moving. Right. So that's a fully employed market is considered 4%. We're below 4%. So I still think that the Fed is going to look at it and see that there is enough pressure in the market that they're going to want to raise rates. And I think they want to raise rates. I think they're looking for the opportunity to do it because they don't have a high enough rate when and if there is a downturn. There probably will be. They don't really have, what do they do? First thing they try to do is lower rates. Quantitative easing was secondary because there wasn't any capacity to lower rates. So quantitative easing is what they do if they don't have the space. Well, now they have GDP going up. They have unemployment at an all-time low. I think they're going to use that and inflation going up with and without oil prices, right?
Well, but 0 is not the lowest rate.
0 is not the lowest rate, but we've never gone negative in this country.
We haven't.
We haven't. I know Germany did.
Lots of Europe is in a negative interest rate.
Did, but we've never had to. Right. I think they're going to want to reload the gun. I don't think they're done. I think they're done for now. I think they're going to let it stabilize for now. Then I think in the second half of the year, next year, they're going to raise it some more. And I'm curious to see what the reaction is going to be.
So here's, in order to get interest rates rising, right, you really have to have stronger growth. And you look at the leading economic indicators, we're pretty flat right now, right? And so if you look at, in order to get real wage growth, you're going to have employers really fighting more for these employees and then have that translate to more inflation.
I think we're going to see that.
But that's a smaller number because your cost of everything else is so low. And that's why I kind of default back to oil prices because oil affects everything. And so if you get oil that just starts increasing, whether your wages are going up or not, you're paying more for everything. And so without that, I don't see the wages as much, especially today where you have, you have a scenario where the demographics are coming of age and they're going to be spending more money. So even with that wage growth, they're going to be going into, more. Listen, if you're 25 to 30, right? And the millennials are behind, they're a little slower than everybody else, right? But usually what happens, they start to date, right? And, in previous generations, they were dating earlier and then getting married. And when they get married, they have kids. When they have kids, they say, hey, we got to buy a house.
We got to buy a house.
Right. So they're doing this later in life. And so everything's been pushed back a little bit. And the big wonder for many years was, when are they going to start spending money? Well, before it was, when are they going to start making money and get out of the basement?
When are they going to make money? When are they going to start spending money? 35.
Yeah, but they've gotten out.
Instead of 25, it's going to be 35.
Yeah, so I think that you're starting to see a lot of millennials, and if you're a real estate agent that's in that entry level price point, you're starting to see a lot more millennials that are entering the
30%,
the price point.
34%.
But here's the other thing to answer your question earlier, where you're talking about that this kind of crash, and the mortgage market has really never looked like our borrower profile has never looked better than ever. Because right now, I look at the homes that I'm selling, and we're like the one in Culver City right now, got $600,000 or $700,000 down, and you look at a 25-year-old kid. Right?
But I'm just saying, local market specific.
But if you look at, but you look at Long Beach, you look at, all these, we have very high down payment buyers, very well qualified. There's none of these really funny, no doc, no loans, just doc and sign, just give us a paw print, we're good to go. That's gone, right? And so without that, if we didn't have this big, balloon and this big, we haven't had a boom. And it's very difficult to sit there and say, hey, we're going to have this bust when you've had no boom.
Okay. I don't disagree with everything you just said.
Thank you.
It's lovely. You said it very well. I don't disagree. But I do believe that we are going to see a downturn. I just don't think it's going to be severe. I think it's going to be very regional. I think Denver's going to have a problem. I think San Francisco's going to have a problem. I think it's going to be very regional and very specific. I don't think it's going to be extreme. I don't think we're going to see more than a 20% downturn. Some people are suggesting a 35% downturn.
20% is catastrophic. That's a big downturn.
I'm saying in the markets that are regionally affected, I think are going to be 20%, not 35%. I mean, Las Vegas saw an 85% downturn in the last downturn. I'm suggesting it's going to be mild and it's going to be regional, but that we are going to see it and that they are going to increase interest rates, and there's not enough interest from the millennials to counteract that.
All right, so here's the question, right? Let's say that's the case, right? So wait. So
hold on. So I think rates are probably going to try to go up, and the economy is going to not work, and then they're going to push it back down.
Push it back down, right?
But
so.
Josh, what do you think? Do you think rates are going to go up or down?
Because we're going to battle this back and forth. That's all. We got to switch over to somebody else.
We'll be on interest rates all day. So
I don't think rates will go up until inflation skyrockets. I don't think they're going to go up in the near future.
Awesome. We got a question back here, and then I'll come here and I'll move over here.
The whole Chinese and the whole bonds. So I talked to a hedge fund guy who works at a hedge fund. He said because of like the bonds and gold, that's one of the reasons why rates, once we have a trading, will try to probably go up.
You're saying because they're not buying our bonds? Is that what you're saying?
Stopped, or like there's some issue there, and that's one of the reasons why the rates.
Yeah, but it's only it's. I mean, they own international markets only own 6 to 7 trillion of our debt. I mean, they don't really. Considering how big our debt is,
we're at what 22 trillion, right?
Yeah. So it's not. I mean, it's not actually the bulk of our debt. We actually, as Americans, own the bulk of our own debt.
Where'd Tim go? Tim was here.
Tim was here. He was waiting.
Tim's in the restroom.
Lost your spot.
There you go.
Awesome.
Thank you, Tim.
Thanks, Tim. Tim, you got a question? You get to answer your question. You get to ask your question.
Back on a global scale to affordable housing. So you're talking about mobile home parks. So I'm curious about: are you still buying? Or if you are buying, if you're not buying anymore, why aren't you?
Sorry, buying what?
Mobile home parks. Sorry, affordable housing communities.
Why? Sorry. Thank you so much for that. Thank you for the napkins.
He's still back on the napkins. Give him a moment.
Anyway, am I buying? Do I want to buy? Yeah, absolutely. But right now, mobile home park cap rates are at an all-time low. By all-time low, I mean 300% lower than they've ever been. So I don't see how you could buy a mobile home park at a 6 cap when it's been in the 9, 10, 11 for the last 30 years. Now, am I still looking? Yeah. Would I buy one if I found a deal that I liked? Absolutely. But I just don't see it as a viable asset class when, the yields just aren't there. And I'm not talking about mobile home parks in nice areas. I'm talking about tertiary market, outskirt mobile home parks going for mid-5 caps. It makes literally no sense to me. So I was at an event in Chicago in October, and there was a mobile home park for sale in Rockford. If you don't know what Rockford is, it's like an hour and a half outside of Chicago. And this was a piece of junk. Like, this was a brutal park. I would have bought it for the right price, but they wanted a lower cap rate than, a multifamily deal in Seattle right now. And that's just where the market is because there's such limited supply and there's a lot of demand. So to answer your question, I want to buy, but I'm not. Yes. I do look for a delta, but a lot of it's gut feel. I think to have a park that's out there while it's producing money and all the tenants own their homes and it's great. I think a rate of return needs to be a cash on cash return needs to be met because the appreciation on these things, you're not adding much value to them. I mean, you could raise rents, but you're not adding much value to them. So appreciation is all speculative, and I'm not really a speculative buyer. So it has to be worth my money on a yearly basis for me to buy it. So, I mean, I've heard mobile home park gurus talk about a 3-point spread. That's not going to happen right now. But if you could get a 2-point spread between borrowing and cap rate, I think it's worth it. Yeah. The pricing is going to be crazy, but
you don't see one coming in, you're seeing a lot of the buyers right now is really strong. You're seeing a millennial 25-year-old guy buying $600,000 property. From my end, I operate as a lender. I'm noticing a different type of bust. And what I'm more looking at is, I call it more of the baby boomer bust. They're cashing out. And a lot of them are giving their money to the kids. Whenever I see a 28-year-old show up with a $200,000 deposit to buy a home, house goes, you wonder where are they going to get the money in terms of playing corporate babies. It's all the money is being transferred. I see a huge transfer of wealth coming in, so we take them out of the spot.
I agree, but that's not a bust.
No, I mean I see a change of it.
Yeah, but that's why I said that, I don't look at this boom that a lot of people, they look at this demographic and they say, hey, we're going to have this boom because these millennials are coming in, they're going to buy all these houses. I look at it like they're replacement buyers more so than a boom, because exactly what you're saying. I mean, that's exactly what's happening, right? So the question really that you should ask yourself is, just like in 2008 and 2009, you had this downturn and a lot of people got hurt, but there were a lot of people that made a lot of money during that time. So the question is, there's a clear change that's happening here, right? Whether it's a recession or not a recession, it's not as relevant as that it's changing, right? And so how you operate and what you do as a real estate investor also has to change. And so just think about it, right? Generally, we're real simple. We buy low, we sell high. There's no, but you also need that distressed sales. So distressed sales right now are only about 4% of the market. So if you have all these real estate investors, and I think that's part of the reason why you have so many gurus that come in, right? Because when you can't do it, you just teach other people how they were supposed to do it. That doesn't really work anymore, right? So but they make a lot of money. And it's the same reason with like, you got all these guys that sell, hey, it's the next stock, it's this. So this is how you protect your money, because everybody's afraid of losing money. And the reality is, just figure out what the next niche is, right? So you said it exactly right. Baby boomers are aging out. Millennials are coming in, right? Whether they're getting the money from their parents or not, it's not really relevant. It is transferring, but how do you cater to that, right? That's really where you're going to make all the money. So that's.
I agree. Right. I know where the next niche is.
Right.
I think it's important to understand too. He brought a good point with the millennials or with the baby boomers. A lot of them don't have enough cash flow to survive, so they're going to be cashing out a lot of these funds out of the stock market and stuff like that long term. And you look at the investments, that traditional investments, and they're just depleting and depleting and depleting. And you look at the savings rate, and it's real scary right now. With what's happening.
But the savings rate's actually higher than it's been in a long time.
Really?
Yeah.
Interesting.
Yeah.
I didn't know that.
So the personal savings rate is higher now than it was pre-downturn.
So people have 1,000 instead of 750 in their bank account now.
It does kind of boil down to that.
Yeah.
I mean, if you're looking at a national number,
Yeah.
we keep getting confused, I think, a little bit because we're in the Southern California market, and so we see, I'm selling in Pasadena, he's over in Culver City. These are high appreciation, high wealth markets. When you move into more of the Midwest and you're dealing with apartment buildings, dealing with mobile home parks, then you're dealing with more of a national market. And we kind of forget that 75, West Coast, East Coast, we forget there's this whole thing called the Midwest in the middle, right? And that's where you get those sort of cash flow homes that are slow appreciation, buy in, just the cookie cutters, and it's your cash cow, and it gets you $200 a door, and if you're lucky, it gets you $350 a door, and we kind of forget that the bulk of the world is made up that way. So when we talk about appreciating and depreciation as a national number, then, we're talking across a much more diverse population than what we're talking about here. So what's the niche? So for me, it's always move from appreciating to move out of state into more of a stable market. And so I'm moving from Los Angeles into Indiana, because that's going to be a more stable market, regardless of whether it's going to be what Robert Campbell says a 35% bath, or whether it's a regression to the mean at 20%, or whether it's,
Yeah, I'm not a big fan of investing out of state, especially for flipping personally. If you're buying and holding.
I'm not flipping.
Yeah, if you're buying and holding, that might be something.
Yeah,
but even with the buy and hold.
I'm a little different on that sale.
That's true. You are.
So here's my issue with even the buy and hold stuff out of state, right? Josh is doing, I think, right, because you're buying larger multifamilies, and that's the way to go. The problem is if you're buying one house out of state, and you have a problem with the management company, and you're going to fly out there and stay somewhere and to manage that issue, there goes all your profit for the year, if not that year and the next year. And so you're working for nothing. So why not do that in somewhere local that you can drive to within an hour or two? Because there's some pretty affordable places if you go in a 2-hour drive, that you can get from here. I mean, there's homes that you can buy in the desert. There's homes that you can buy
Apple Valley, Bakersfield,
Sacramento, where, I mean, there's places within California that's.
You realize they sell properties out of state to investors, right? So.
Yeah, well, we're not here to make you, Matthew. We're not
I'm
here to
a good
make
management
you happy,
company, so
okay?
don't worry.
We're here for everybody else as well.
Sorry.
Just saying.
I don't care. I have plenty of buyers. Don't worry.
All right,
There's no inventory still.
So when you replay this later, it'll be a part that's edited.
Cut it out on Facebook. Don't worry.
So no,
that's okay. Let me talk next because I'm in support of out-of-state property. So there you go.
Yeah. So I do like. I like staying local. I've always said staying local. I did have a bunch of properties in Texas, and some of them we got killed on, and some of them we did fine on. But the reality is that the management of it is just it's a real pain. And so for me, this is just a personal thing. I just don't want to be able to have to fly somewhere to handle an issue like that. I hate issues, period. For me, I like things to move, be smooth and just kind of trek along. And that's one of the reasons I do like the flipping. I like the larger apartment buildings because then, you've got your staff that you've trained to do that. And that moves like where Josh is set up. They've got a whole setup and they're buying larger buildings. And then it makes it worth it if you have to fly out to Indiana or Colorado or Denver or wherever, right? And so, if you're doing one or two houses, for me, that's not the deal. For you, it works out well. I think, you guys both do well. But you have a business where you're doing it, so it makes sense.
But we went through 5 managers in the beginning, and lost a lot of money learning how to do it out of state and getting the right quality control and being on the manager's ass all the time and things like that. It takes a ton to get that done, so.
Yeah, and I specifically have a system on buying in concentrated areas, whether it's single families or multi-units, so that I don't have 2 doors or 3 doors. I have multiple doors. I'm dealing with 30 doors, 40 doors, whether it's single family or whether it's multi-units, and I'm dealing with a property management company, and I have my system for dealing with my property management company so that I can control, instead of buying one property here, I can buy, 20 there. So I'd rather, do that and protect my assets in a depreciating market where I just don't know. I think it's going to be a mild downturn, but I think it's going to be a downturn. I've been upside down. I don't want to be upside down. That's just saying. That one, being upside down hurt me more than managing out of state.
My question's actually for you, Matthew. What cap rates are you seeing in the Memphis market, and what niches do you see in Memphis?
So in Memphis and the Midwest, you can kind of group them all together in certain cases. You get a little bit better cap rate in like a St. Louis or a Little Rock or something like that. But in Memphis right now, I'm selling high. I don't buy the low end stuff. So you gotta watch out for the lower end stuff because the cap rate looks good, but in reality it's not. So that you have more vacancies, more bad debts, and more tenant turnover and vandalism and theft and all that kind of stuff. More repairs from tenants not taking care of it, and they're judgment proof. So we stick with the $100,000 to $200,000 plus price points, and we're usually selling market value at around 7, sometimes 6 caps. 6 and 7 caps. That's fully renovated, perfect, brand new. Everything, and systems good for 10 years type deal. You can get stuff cheaper, especially if you're buying it yourself and, putting more lipstick or not doing all the systems and that kind of stuff. So it just depends on what you're looking for specifically, but you can get stuff in the 8 caps and, 9 caps if you're buying it yourself and that kind of thing. But, and in St. Louis, you can get them even higher, but, you gotta watch out for the hood and the right neighborhoods and things like that. You gotta know your neighborhoods. You don't buy the $60,000 house that rents for $675 necessarily. There's a product for that. If you're buying cash or something like that, you don't want to get financing on that because usually most lenders want to finance it $50,000 or more, and you're going to waste one of your 10 houses on a $60,000 loan. Sometimes it doesn't make sense to do those, So, but cap rates are absolutely compressed. In 2012, we were selling at 9 and 10 caps, and now we're selling at 7. So, our margins went up, and it's harder. There's so much competition there, but the niches are just like anywhere else. I mean, I look at the multifamilies there. I look at, the short-term rentals there as well, because cash flow on cash flow works really well, so, and, those are the different strategies we focus on. And there's a lot of demand and a lot of money chasing and hedge funds chasing properties and things like that. So if you're not going directly to the source, you're paying retail, whether it's retail and needing to fix it and being retail there, or finished and retail, so make sense? Any other questions? Question here?
This is for Christina. As I'm a cash on cash, that's what I look at. I'm a cash flow buyer. And I have properties in Southern California. I kind of say it's Southern California Central. You're kind of the underwriting queen on the stage right now, in my opinion. How do I know my underwriting that I'm doing as an individual investor is accurate? As far as when I'm going into a new market, like I was in Bakersfield, and I don't think I underwrited a few of the deals that I did personally, as far as the expenses go, and I think you're extremely conservative. But how does anybody go to a new market and be like, all right, I need to learn about this market. Like, do you look at costs from business that people sold? Do you do the thing where you call property management companies? Because I feel like I can go on Bigger Pockets and I can look at 15 people and 15 different suggestions about, oh yeah, your vacancy rate is going to be 5%. Well, east of the 99, it's going to be 20%. And those are the kind of things that really make it confusing on what I'm going to offer.
I spent 10 hours teaching that in my mastermind course. So I can't give you 10 hours worth of information because I am a little bit of the due diligence, fanatic. It's true. I do have, like a 27-point checklist for what I want to know on the level of city before I even start getting, and then I start getting into neighborhood and how do I get to neighborhood. And then I have that particular building once I've got that neighborhood, and I expand back out again. So I have a whole process, and I can move into a new market with a minimum of 6 hours of research, preferably about 10 to 12 hours worth of research. Now, if you're looking at investing $100,000, 12 hours of research is minor. I mean, that's a minor investment in making sure. And then once I've done that research, then I actually fly out there. So yes, all the above. I research management companies. I make sure I have a team on the ground. I will fly to a city a couple of times before I actually invest. I'm looking in Indiana right now. I've already flown out once. I'm going to fly out again. I might fly out again to make sure I have a team that I'm willing to work with that actually will perform. Why have I chosen Indiana? Well, I hired this lady, to me, she's a young girl. She's 26 years old, and what she does is data analysis for, new developments and environmental impact. And I said, here, look at this city. Give me your data on this one. So I do spend a lot of time, but I'm not afraid to go out. And Google is amazing. I'm looking for, historical charts of vacancy factor. If I can't find an actual chart, I'll just go through historical articles of newspaper articles that are in that area. I honestly, is there any property managers in the room? Okay. And you don't have any rotten tomatoes, right? So I'm just saying, I never believe property managers or real estate agents on what the vacancy factor is, right? So I'm pretty aggressive in that, in learning it myself. I ask lots of people. I call 5 different property management companies. I talk to 5 different real estate agents. I ask very similar questions of both of them, and I start to both get a sense for them as a team member, as well as an aggregate of data as to what's true for that. Like you call Texas and they go, oh yeah, absolutely, vacancy is 8%, no problem, all day long. But then I talk to other people and I look at newspaper articles and it's 12, and I'm like, okay, it's 12. That's what
I would interview those managers specifically, and nowadays the bigger ones have a lot of data sources right now, meaning not on their own properties and their own products in a market. So a lot of them will track, this is my vacancy rate across the board with all that, because it's a marketing tool for them. Yeah. But they can show you those things, and it's almost like you're interviewing them. But it's backing up every single one of those different numbers that you're trying to do, saying, what is my utilities going to be? And let's go to the utility company and see what the averages are and stuff like that.
Property tax, vacancy factor, city tax. Also, like Knoxville, Tennessee, I didn't know they had a corporate tax. They tax you on the full value of what you're holding, whether you made any income or not. So I it's kind of a pain in the ass.
What do you do?
That one
What do
didn't
you
work
do,
very
Josh?
well.
What do you do, Josh?
We lean on our property management companies a lot for expense data, for other income data, just on what we think that it'll pencil out at. In a lot of the markets that we're at, we own a lot there, so we aggregate our own data at this point. But we lean on our property management company a lot for just kind of a check on what our assumptions are. Especially because if you're going to use a property management company and they give you their assumptions, they're going to stand by them. So
if they're not criminals in the first place, which a lot of them are.
Yeah, I was going to say, I actually don't find all my property management companies will stand by them, but my units are smaller; they're under 100. So
yeah, exactly. So I think it's a lot easier when it's bigger properties.
When you're doing multifamilies, you get the professional managers that come in and you're asking them about all their softwares, and really the vetting process with all of your team is the most important thing in any due diligence piece is that, and knowing that, or finding ways to make sure they don't screw you over, so. Question, Tim?
I had 2 cents. There's a good place called Spurling.
Yeah, I use that sometimes.
I think that's
all you need. It's called bestplaces.net. Just go to that. I use it sometimes. Like you said, take it for what it is. Yeah.
yeah, you can find a lot of census data on city-data.com. I find it a little easier to understand that site, but it's really census data. That's really what I'm seeking.
And you're taking data for what it is, right? You're reviewing it, but then you're analyzing your deals and your market and your neighborhood specifically, and including going to the police department and stuff like that, and talking with them and doing all this kind of homework on it. So I think that's really important.
I think there's nothing like actually driving the area that you're looking to buy. I think that's the most difficult part of buying out of state is really knowing. You could go on Google Maps and drag the little guy on, but there's nothing.
And I do, but then you have to drive out there.
But it's not even close to the same as actually being on the ground. You can tell a lot about an area just by walking around or driving around. What's going on there? What's the buzz? What's the feel? What stores are popping up? As like corny as this sounds, like we were looking at buying a property and a Whole Foods was being put up across the street. Ding, 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 like we're in, just stuff like that.
John's versus Vons versus Whole Foods.
Right, like these, big chains do a lot of research on areas, so if they're coming in, there's a reason for it.
And do yourself a favor.
John's. Anybody? Hey, I own by a John's. Anybody else own by a John's? Come on, it's a perfectly good market. Thank you very much.
He has a question.
Question, Jay?
If I can, I just ask you. So, onto your point on my favorite things to do, yes, go see the place. But when I'm looking for a property manager, I always try to find the mayor's breakfast. And the mayors have to function a lot of the non-corrupt real estate people. Usually will make an appearance, but they won't hang out with the police. Right?
Thank you, Jay. That's a good one.
Yeah. And then the second one, and when I'm looking, especially if I'm looking at a new city, area, or town, I really love this one, is I go straight to Walgreens and I go straight down the hair care aisle because I don't know about this kind of hair. Walgreens knows, and they do their research, and I can give you a lot about
You also.
I like that, Jay. I like that one a lot.
That's awesome.
That one is new for me.
Yeah, I've
I have
never
to
been to
confess.
Walgreens for that.
I will add that to my due diligence list.
I
Go
would
to the
say,
Walgreens.
Secondly, when you're going to the market specifically, make sure you go. I was telling this. I forget who I was telling this to earlier today, but go during the day and at night or on a weekend. I've been taken to Memphis in the hood during the day, and I'm like, trees, beautiful, wow, great neighborhood, and then you go down at night and you're like, crackhead, watch out. And you buy in the wrong areas.
Boys, abandoned cars, right, and sofas, abandoned sofas.
Coming from when you're coming from California, all these other areas, they look beautiful, right? I mean, it's like, wow, these houses are great. Yeah. No, not so much.
They're green.
Somebody
we've been discussing
in front of one of our buildings.
Not just whether or not there will be a downturn, but whether in fact there will be a downturn.
Yeah, it's crazy.
But I think the thing that hasn't been mentioned at all is that the US property market just doesn't exist on its own, like it's insulated from everything else. We're a connected world. Yes. You've got to look at the stock market, and the US stock market is an exponential curve. And you look at previous downturns, and when they occurred, whether it's 6 years, 8 years, and extrapolate out where we are right now, and look at the shape of the curve, you've got to take that needs to be taken into account.
Yeah.
And then we've also got a connected world where other stock markets, financial markets around the world are interconnected. You've got the Brexit issues at the moment, which are causing a lot of concern ongoing, and they've been ongoing now for 2 years. So I think I'm just offering those comments up. You can't just look at, because each person's opinion is going to be different as to whether or not the property market here is due for correction.
I think that's key, right? You guys, you see a lot of this stuff. What do you guys see happening?
I was going to let Robert take it since he turned his notes over to a
I
new
did,
page.
I did.
I just have to give it to him.
So there's 6 things that we kind of identified generally for a recession call, right? And the first is that the Fed has to raise interest rates, right, which they did. The second is that unemployment, this is a little bit more complex model, but basically has to be above a certain point based on the current demographic. And since we're at basically full employment, that's kind of, you're going to start to see some issues that derive from that, in that we can't employ more people than what we've got, right?
And supposedly wages should go up. I'm just saying.
Right. Well, wages, they should, but they just, we'll see, right? The other thing is that you have to have a yield inversion between the 10 and 2 year bond, right? And so we had a temporary yield inversion, but in order for it to be considered a true inversion, it has to hold for 10 days, held for 2, didn't count. You have to have an overinvestment in something, right, is the next thing. And we have, but you don't have this, you don't have a huge overinvestment in tech. You don't have a huge overinvestment in housing. You're not, it wouldn't be what you would call I wouldn't call that like an overinvestment. That wouldn't be, that's just my personal opinion. And you're welcome to disagree. But, the other thing is, housing starts have to fall, right? And housing starts this cycle they're not going to fall because they're going to grow a little bit. Right. And part of that is that, from 2008, 2009, everyone got into apartment building development so all these builders that normally would build single families started building all these multifamilies, right? So if you just drive through K-Town or Hollywood and you see all of these buildings that have gone up. And that was the basically class of new construction that was being created. So we haven't had housing starts really start to fall. I don't think anywhere near that. In fact, we're at probably, like 1994, 95 recession kind of levels right now for housing starts. So I don't really say that as being an issue. And the other thing is that the last thing would be that you've got to have the leading indicators that they all turn negative for a period of about 6 months. Right. So if you have, those things that start to happen, and can they happen very quickly? Sure, they can happen very quickly, but they're not even, there's several things that aren't even in the horizon right now that are looking. So I think we're pretty solid for 2019 for sure. I don't see any recession or anything like that happening this year. I do think that certain submarkets are going to have like slight corrections, especially locally where you've got overdevelopment. And I think that was foreseeable. And if they were looking, right? So if I had been looking,
if I had called you 6 months ago,
if you looked at construction starts, right, you would have seen there's an overinvestment in that area, right? And so, but I think but it'll work its way through, and part of what happens when you have an overinvestment, people stop investing there, right? And then there becomes this shortage, and it'll just get cyclical again. So I think that we're pretty good through 2019. Probably 2020 is what
What do you guys think about the some of the challenges, the economic challenges we're seeing? Like I was mentioning, the government pensions, the auto loan default rates spiking, the loans from students being outrageous and major debt,
and unsecured debt, right?
Right, and I feel like you're looking at the general population being very loaded with debt, right? And so that may be a long-term Japan type problem, potentially over long term. But what do you think that's going to do in the short term? Or
go ahead.
I want to talk to David's point for a minute, and I'll let Robert take that one. This last upturn and downturn was the first time I think it became the most clear, at least to me, that you could see the charts that we had a huge rise in our real estate prices. So did Canada. So did other countries as well. So did most of Europe. I mean, this was an international Great Recession. So just as there was a core change in the stock and bond market in 2000 with the tech burst, which really didn't have to do with the tech burst, it really had to do with technology changing the way trading was being handled in the stock and bond world. I believe we now have a distinct change in our economy and even in our real estate that is no longer freestanding, and you cannot consider it freestanding at all. I mean, they were talking about contingency. I think we're talking about truly this is going to be horrible. All women, when you work together, your periods start going together. Like we're talking. I told you it was horrible. Okay, I'm sorry. I said it was horrible. Count on a woman to bring a new point of view to real estate. Okay, but truly, we. So really, we are talking about.
By the way, you can't really see this, but everybody's mouth was open at the same time.
You can count on me to be entertaining, maybe not knowledgeable all the time. No, but the point is, it really is, we are actually moving together. And I think we really need to stop being so U.S.-centric in understanding that. I'm not focused on the international right now as I was back in 2015 and 16, because I'm not seeing that Braytech, I'm going to say it wrong. I say it wrong every time. Thank you. Or the concerns with China are going to truly pull us off course. So I'm not focusing on it, but I'm not ignoring it, right? And I agree that, when I do economic updates, I literally spend an hour and a half, and I start with the U.S. market, and then I go global, because you can't ignore the global. So to answer that, yes, but I'm not seeing anything that's concerning me. I'm more concerned about what we're doing here and what we're going to do to handle our stock concern and the hyper appreciation in the stock market. I think that's more of what I figure is the bigger risk.
what do you think, Josh?
Sorry,
what do you say?
I think our biggest problem is student debt. Maybe not biggest, but it's a problem. I don't really know how to fix it, but I don't think that's going to cause a downturn. I just think that's something fundamentally we need to change. For me, what might cause a downturn, and Robert alluded to the opposites, but I think, to me, there's so much tech that has been overinvested based on projections and not money. And I think that's a problem.
Well, I'll agree. Amazon. I mean, I hate the tech model. The tech model is terrible. The tech model is basically, we're going to raise money because of something that we potentially could do in the future. Right. And we're not going to worry about losing money right now. And people buy into that model, which is, I just think, it's completely asinine.
At some point, they're going to have to scale down to make money. And I think that might cause a problem.
Get rid of the student debt bubble. You just got to take the money from the government out of it, stop subsidizing it, and make it so that people can default on it. And all of a sudden, you're going to have an evening out of the student loans.
Listen, we've had like a student loan crisis that's come up before. It keeps coming up again. But the reality is that you look at the incomes of a college graduate, right? Here's the biggest risk. The biggest risk is not the college graduate, because they're going to make enough money to support that student debt. And they're, and over their lifetimes, they're going to make X amount of millions of dollars, right? And so to have a $100,000, $200,000 debt is not significant enough for that. The problem is if you went to college and didn't graduate and you took on this debt, that subsection is the one that's going to have the biggest problem, right? Because now they don't have that degree to lean on and get that higher paying job and do all this stuff, but they've got all the debt. And so that's the submarket that I think is probably the most problematic within that. But it's a smaller percentage. It's not like it's 80% of those kids. It's, so I don't really see that I actually think that, especially with the demographic that we're at right now, I think that the personal debt can actually, it's moderately can increase still some, and it has some to go. I think real estate still has, because of that, some growth. I don't see it as, now is it robust as what we're used to seeing? And part of being on the West Coast here, this is what you like. Southern California, I've always looked at, it's kind of an island, right? I mean, we got the farms here, we got the mountains, which really not a lot of people except for mountain folk and Walmart shoppers live out, right? And so and then you got the ocean, and then you got Mexico, right? And so in Southern California, I mean, that's one of the reasons we have so many fluctuations is that when everything's equal, you'd rather live in Southern California because the weather is just so good, right? I mean, you might listen, whether you agree, disagree, whatever with politics here, doesn't matter. The weather's just fantastic. So it's just, you just want to live here, right? And so, I mean, right now we're like, God, it's raining. This is terrible. It's the worst. So anyway, but so I don't really see, like all of these crises that are happening, especially with the demographics that are kind of coming online. I think they're going to be expanded a little more. I don't even really see like debt, like, we're 22 trillion deficit. I think we're probably going to get to 60, 70 trillion before, by 2060 is my guess. And it's fine because, you've got, and that'll be basically, I mean, look, if it's 70, you're at 3 times the GDP, or it'll be 3 times GDP now.
That's
right?
what's important, is the percentage of GDP. So, it's not the size of the number, it's the percentage of GDP.
It's going to be, but it's also going to be fine. It's not, look, we have, and I don't see this changing for the next century, or at least the finishing portion of this century. We have right now the strongest prime age workforce, right, in the entire world. And the one thing about Americans is they have a very good work ethic. And so GDP will continue to grow. I think you'll keep seeing it just trek along. And, that's my viewpoint. And we can talk in 20 years and see who was right. Right?
Well, if I were to bottom line it, what I would say is, I think we're going to see a downturn. Like, I was really clear about that. I think we'll see a recession.
How much?
I think it's going to be a mild.
So how much?
What's the date?
It's going to be mild.
1%, 2%, 3, 5, 20?
Oh, I can't. I don't have that number. I'm sorry.
Okay, but
I know it's very disappointing. It really is. It's really disappointing. For a data head to not have that number, oh my God. But I do think that ultimately in real estate, right, that we're going to see, you talked to this earlier, that the financing in real estate is very stable and very strong. I'm actually not worried about the stability of the real estate market by itself. I think we're going to see downturns in markets that have shown large appreciation, because if you breathe in really deeply, you're going to breathe out really deeply, right? So if you want to be safe, be careful being in a market that has seen and experienced high appreciation. I'm more worried about the stock market and the inflation in the stock market and what that will do to us. But I don't think it's going to destabilize real estate in a huge way.
Okay, thank you guys very much. I really appreciate it. Thank you guys. Okay, one final question before we go down to North Italia. You guys basically exit this door right here on the back. You go around these glass doors to the back and then make a left and another left, and you're right here at North Italia. So who agrees with Robert right here that the market is not going to take? Raise your hands. Okay, and who agrees with Christina? It's going to... down. Okay. I'm hoping for a tank because you make a lot more money in a downturn than an upside. But I just want to see this. What do you think, Josh? You're more of a Robert? Okay.
We should reconvene and we should have this same panel, right, in 12 months and see what happens, right?
Do the same thing.
I could eat crow or
We're going to have a bet.
We're gonna do the fear factor thing. Whoever loses has to eat something crazy. So, all right. Well, thank you.
Make that bet.
Nice. Well, thank you guys very much. Feel free to come the next time. You guys can find us on meetup.com and.